Buckle up. It's time to talk base rate basics. So, imagine you had to guess the probability of a trade closing in profit. You don't know what asset is being traded. It could be gold, it could be the S&P 500, it could be a meme coin. You don't know which direction it's being traded. It could be going long or short. You even don't know the time horizon for the trade. It could be set up in a way where it would likely close within an hour, or it could be a trade that would likely take weeks or even months to close. All you know is that it's a one-to-one trade. That is to say, that it has a static take profit and a static stop loss that are equidistant from the point of entry. Now, if that's all the information you have, I think most people would still say they'd be able to come up with a good guess for the probability here. It's 50%, right? I think that's very reasonable given the information that we have. But can we do this if the trade is 1.5 to 1, or 4 to 1, or 99 to 1? Is there a way we can come up with a similar probability estimation as this when it's not a one-to-one trade opportunity? This is what the base rate can tell us. So what is the base rate in trading? The base rate of a trade is the percent chance an asset will reach one specific price, which we can call outcome A, before another specific price, which we can call outcome B, if price movements are assumed to be completely random. And the formula for this is B divided by A plus B, where A is the distance to outcome A in pips, and B is the distance to outcome B in pips from whatever starting point you have in your analysis. So in this example, it looks like a trade, but it doesn't have to be a trade, where outcome A is 20 pips away from wherever the price is now, and outcome B is 10 pips away from wherever the price is now. And for this example, it would be 10 divided by 20 plus 10, so 10 divided by 30, which is 0.333 or 33.33%. It has a 33.33% chance of reaching outcome A before reaching outcome B if price movements are assumed to be random. One important thing to note here is the base rate always corresponds exactly to the break-even percentage for a trade. That 33.33% probability we attributed to the previous example, that also happens to be the exact percentage that a trade with that risk-reward ratio would need to close in profit to achieve a break-even status. But is this right? I first encountered the idea of base rates in the Duomo Initiative's Trader Development Program. And actually, while preparing this presentation, they happened to upload an interesting video that has a way of introducing the concept of base rates as well. And I'll provide a link to that in the description. But anyway, because of the way my diseased mind works, I was really uncomfortable with the idea that this was true and came up with a number of reasons I thought it might not be correct. Like, does it hold up in extremes? If the trade is highly asymmetrical, would this still hold true? And I do think looking at things, extreme examples, is a good way of thinking about ideas and really challenging whether they're really valid or not. But, well, I'll go more into that in a minute. What about specific situations where it doesn't seem like it can be true? I thought I came up with some ideas where I just thought the probabilities that the base rate present just don't seem correct. And can randomness be described so simply? To me, it wasn't obvious even what randomness was, and if that's the case, how could it be that one simple formula could describe potentially any kind of randomness that could exist? So let's go through these one by one. First, does this hold up in extremes? So here I have set up a situation where there is a 1 to 99 ratio between the distance for outcome A and outcome B. The base rate of outcome A happening before outcome B is then 1%. My gut instinct told me that this is too high. It just seems so easy for outcome B to happen, and nearly impossible for outcome A. But what I'm going to do here is argue that my gut instinct here was wrong and likely reflects the difficulty humans have at accurately assessing the probabilities of unlikely events. For one thing, if the risk reward ratio didn't correlate to the break even percent, it would be possible to trade profitably by opening random trades with specific risk reward ratios. Because of how mindless this style of trading would be, it would be possible to open thousands of positions a day without any thought and make a lot of money very quickly. To my mind, this strains credulity far more than the idea that a 1 to 99 trade has a 1% chance of closing in profit. Okay, on to supposed counterexamples. At the time I'm recording this, the NASDAQ 100 is trading at 24,000. The base rate concept would suggest that if I were to guess the probability of the NASDAQ plummeting to zero, just absolutely wiping out all value, or climbing a relatively modest 25% to 30,000, the chance of hitting zero before 30,000 is 20%. But this really doesn't seem right at all. I've come to realize that all this is really telling us is that we have a strong and I think reasonable assumption that price movements in US stock indices are not completely random. There are various factors that lead US stock indices to have a directional bias that shifts probabilities away from the base rate. But I wasn't really aware of these assumptions that I had built up until I started to ask myself, what if I didn't know this was the NASDAQ 100? What if I didn't know which direction it was being traded? And by asking these questions, it became more obvious to me which assumptions I was bringing into my analysis. If price movements were completely random, these probabilities would hold true. But the base rate concept is not saying that price movements are always inherently random. Okay, this last objection is perhaps a little specific to me, but I wanted to find a way to model this randomness to really prove or disprove this base rate concept. And for a long time, I couldn't really decide what a model of randomness would even look like. If you go candle by candle, sometimes price moves very little for a long time, and then sometimes on a single candle, price moves a lot. How do I model this mathematically? And if there's not a single simple model of randomness, how can there be such a simple formula that describes any kind of randomness? What I came to realize is that in the way that we're describing base rate right here, we're only really concerned with price and not time. And when we only consider price, we can simplify things and just assume that price either moves up or down a single tick at a time with equal frequency, an equal probability of it going up or down. When I modeled things this way, I was surprised to find that the base rate probabilities held true, even in the 1 to 99 example that I thought likely would have very different probabilities than the base rate would suggest. Does price really move like this? Probably not, but that's not really what the base rate is concerned with. But alright then, so what? The base rate concept describes probabilities if they are completely random. But why is that useful if we assume that price movements aren't completely random? Why is it that we would have a model of probabilities that doesn't reflect critical elements of reality? Well, this is what this presentation is really about. So first, it's a starting point for probability estimation. The base rate gives the most grounded and neutral starting point for estimating probabilities. If you are going to be estimating probabilities of trades, and you really need to be if you're serious about long-term profitability, it's important to recognize what a grounded, neutral, or even default probability estimate looks like. And this is what the base rate does. Second, the base rate is key to assessing many claims about trading. By dividing the estimated probability by the base rate, this is what I call EPBR, you get a simple measure of how far from neutral an estimated probability is. If you assign a probability of 20% to a trade with a base rate of 20%, that's not a very bold claim because it's indistinguishable from a claim of pure randomness. The EPBR would be 1.0. If you assign a 30% probability to a 20% base rate trade, that'd be a 4-to-1 trade, That's 30 divided by 20, which is an EPBR of 1.5. This would be a very bold estimated probability and would require as much evidence supporting the probability estimation process as giving 75% odds to a 50-50 trade, which would also have an EPBR of 1.5. Now, even if you don't estimate probabilities on your trades, and you really, really should, then at the very least, this gives a way of assessing other people's claims about trading. When somebody says that they have a 90% win rate on trades with a base rate of 10%, that would be an EPBR of 9, which is frankly outlandish and would require very compelling evidence to support it. Third, it offers a shortcut for understanding expectancy. If you're already doing probability estimation, the estimated probability divided by the base rate, the same EPBR, is also a convenient shorthand for expectancy. If your EPBR is 1, you expect to get an average of $1 out for every $1 you put at risk, or break even before transaction costs. If your EPBR is 0.9, you expect to get an average of 90 cents for every dollar put at risk, meaning you'll lose money trading to outcome A at least, before transaction costs. If your EPBR is 1.2, you expect to get an average of $1.20 for every dollar you put at risk, meaning an average of 20 cents profit per dollar put at risk before transaction costs. This can really inform whether you think an opportunity is worth taking and how much you want to put at risk. And lastly, and maybe most profoundly, it underscores sensible performance benchmarks. If you take a heterogeneous group of trades, trades that maybe some of them are 1-to-1 trades, some of them are 3-to-1, some of them are 6.5-to-1, and add up their base rates together and divide them by the number of trades you're in this group that you're analyzing, you get the mean base rate. The mean base rate is the average number of trades you expect to close in profit if trading results are completely random. This is the key benchmark in trading, whether one is trying to evaluate a trade execution strategy in a rigorous and academic way, or trying to interpret the skill-based performance of an individual trader. Okay, so I say this is the key performance benchmark, but what about profitability? So when you see trading strategies discussed, especially in the online space, they're often presented with a homogeneous risk-reward profile because it's easy to compare reported results with a break-even percent. You always see, break-even's 40%, but this does 60% or something. But there is no simple break-even percent when some trades are 2.3-to-1 and some are 3.6-to-1. There are many legitimate reasons to vary the risk-reward ratio of trades, and it's really limiting to only be able to tell what good performance is if all trades are identical. People often use profitability to fill this gap, but as a benchmark of performance, this is far more likely to mislead than if one were to simply compare sample performance to the mean base rate. So let's conclude this presentation by looking at an example. And okay, this is an extreme example, but I think it highlights the issue really well. In this scenario, a trader has made 100 trades, risking $1,000 on each. For 80 of these trades, the risk-reward ratio is 4-to-1. But for 20 of these trades, the risk-reward ratio is 99-to-1. Of the 4-to-1 trades, 12 close in profit, and of the 99-to-1 trades, 1 closed in profit. So if you look at the sample performance of each of these groups, for the 80 trades, 12 close in profit, and so 12 divided by 80 is 0.15, so 15%. And for the 99-to-1 trades, we have 1 closing in profit out of 20, which is 5%. Now the mean base rate for these two different groups of trades is 20% and 1% respectively. If we look at the sample performance divided by the mean base rate, for this first group of trades, you have 0.75, and for the second, you have 5.00. 1 is considered neutral performance. 0.75 is substandard. 5 is exceptional. And if we look at the profit of these two groups, the first group of 80 trades loses $20,000, while the second group of trades makes an $80,000 profit. Now let's look at these trades together. So we're going to make a total for each. So the risk-reward ratio varies at this point. The total number of trades is 100, and a total of 13 close in profit. So the sample performance rate is 13%. 13% close in profit out of 100. The mean base rate here is 16.2%, leaving the SPBR still at a substandard 0.8. However, there is $60,000 in profit. I think many people would look at this performance and think that it's really good. But I think if you look at the sample performance, this 13% of trades closing in profit, compared to the mean base rate of 16.2%, it really highlights what the problem is with this group of trades. Now, of course, a sample size of 100 is very small, and one shouldn't come to definite conclusions from any of this. It's all about interpretation. But if we are only to look at the profit, we might think that this is early signs of very good trading. But the SPBR tells a different story, and it gives an indication that perhaps things are a bit shakier than they first appear. And I think this image is more realistic than the perhaps headline figure of a $60,000 profit. A sample performance of 13% versus a mean base rate of 16.2% suggests that there is a more than 50% chance that these are the results of a money-losing trader. Though, of course, there is still a chance this is a break-even trader that got a bit unlucky, and an even smaller chance that this is a profitable trader that got really unlucky. I mean, granted, the way this bad luck manifested was with a very respectable profit, but if we are trying to figure out the ways that these results relate to long-term performance, well, the $60,000 figure isn't doing very much to help us understand that. The mean base rate does so much more. And sure, maybe there is something about the 99-to-1 trades that do perform better in the long term. But when 20 trades are made with 99-to-1 odds, there's a roughly 20% chance that one of them is going to hit. So while it's kind of lucky that one does, it's not wildly out of the ordinary that one managed to close in profit. And given the limited evidence we have, this is a really small sample size, I think this is the most likely explanation. Anyway, this is just an introduction to base rates and their uses, but with a bit of creativity, the base rate and the tools that can be derived from the base rate can do incredible things for our ability to interpret and understand trading data. This stuff is absolutely foundational.